Good morning. Hidden costs in triple net leases, what most investors and tenants can overlook. And at first glance, a triple net lease or an NNN lease looks like the cleanest deal in commercial real estate. It's got low landlord responsibility and predictable income and minimal headaches. But here's the reality. Most investors underestimate the true cost structure, and that's where deals can break. And if you don't underwrite triple net leases correctly, you're not buying passive income, you're buying risk. And is that what you want? So, what is a triple net lease and a quick breakdown of it? A triple net lease means that the tenant is responsible for paying property taxes, insurance, and the maintenance, often referred to as CAM for common area maintenance. And it sounds simple, but the structure is where problems can start. So let's talk about the hidden costs that can catch investors off guard. First is CAM, common area maintenance. It isn't a fixed number, and most investors assume that CAM is stable, and it's not. It's a variable category, much like your property taxes and insurance. And CAM can include landscaping for the area, parking lot repairs, roof maintenance, HVAC servicing, security for the building, as well as property management fees. And the problem here is that these costs fluctuate and often increase faster than rent can. And then the real risk there, if CAM spikes and the tenants push back, your net operating income is going to take a hit. Two is administrative fees, the silent profit killer. And landlords often charge 10 to 15% administrative fees on top of CAM. And that is rarely highlighted, but it does add up quickly. So on a $100,000 CAM budget, that's another $10,000 or $15,000. The translation there is that your expense pass-throughs aren't clean and they're padded. Three is capital expenditures, which are disguised as maintenance. And this is one of the biggest traps. Some leases allow landlords to pass through a roof replacement, parking lot resurfacing, or structural repairs to the property. And these shouldn't be considered capital expenses. These are capital expenses and not operating costs is the point. And if it's not negotiated properly, tenants absorb them. And then what happens when they can't anymore? Well, then your vacancy risk increases. Four is property tax reassessments. And in markets like Katy, Fulshear, and West Houston, values have been rising. Most of Houston has been. And what that means is that property taxes reset higher after a purchase. We're a non-disclosure state, but sometimes they can back into these things. And tenants may not fully absorb increases, depending on how the leases are structured. So the result is your projected returns could get squeezed post-acquisition. Insurance cost volatility is another category, and it's happening all over the United States, not just Texas, but particularly in Texas. Insurance is no longer predictable. And some of the drivers were the Gulf Storm area, so there's storm risk. There's been inflation in rebuild costs, but also carriers are pulling back out of the market. And that means we've seen 20 to 40% jumps from carriers in the past insurance cycle. And if there's no cap on those expenses, or if there is a cap, the landlord, the investor, has to eat the difference there. So expense caps and gross up clauses. And some leases can include expense caps, which would be a limited on increase per year, or gross up clauses, which artificially inflate expenses to stabilize costs. And if you misunderstand these, your underwriting becomes disconnected from the reality of what you're agreeing to. So why this matters? And the point is NOI is everything. And in commercial real estate, your value is the cornerstone divided by a cap rate, whatever your income is, that gives you your value. So if your expenses are wrong, even slightly, your NOI could be overstated. It means your valuation could be inflated, and then your exit gets crushed. So a $50,000 expense miss at a 7% cap rate, that's a $714,000 valuation error. So how smart investors can protect themselves. First is audit the leases line by line. Don't skim, and focus on the definitions of the CAM, common area maintenance, your CapEx language, your admin fees, and the expense caps. 2 is underwrite above the lease. So don't rely on seller numbers. You need to build your own model where you can stress taxes are increasing or inflate insurance from where they're proposed and normalize repairs if there've been a different history. So ask for historical data. If you can get 3 years of CAM reconciliations or property tax history or information on insurance renewals, that's helpful because if the seller can't provide it, that's a red flag. They're not paying attention. 4 is structure the deal and don't chase yield. And this is where most investors can lose, where they chase a higher cap rate or a lower purchase price. Instead, they focus on a structure, a risk, and the durability of income. So the final takeaway for the day is that triple net leases are not hands-off. They're close to it, but not completely. And they're structure-driven investments. And the winners don't just buy properties. They underwrite the leases like a lender as well. So the bottom line is if you don't understand the hidden costs, you're not investing, you're just speculating. And if you want help underwriting your next deal, please reach on out. My name is Bill Rapp. If you're buying, you're leasing, or you're refinancing in Houston, Katy, or Fulshear, I'd love to be of service. Let's help structure it the right way the first time. Please visit my website, HoustonRealEstateBrokerage.com, to figure out how to get a hold of me. Love to talk to you more. Have a good day.